Welcome back to another edition of Finance 101. Today we're going to talk about home equity. Equity is a concept that says that if you have an asset like a house or a car and it's worth something, and then you subtract the loan against it, what's left over is your equity, or what your ownership interest in it is worth. So let's take the example of a home. Let's say a house is being purchased for $100,000. You're supposed to put 20% down to get conventional financing terms, and then you'd have a mortgage for $80,000. So you, on purchase, have equity of $20,000. The difference between what it's worth, $100,000, and what you owe on it, $80,000. Now, sometimes with houses, you'll have a purchase price, but then when the appraisal comes in, which is supposed to give you a true sense of the market value, you'll get an appraised value that's higher. So let's say in our example, the house is purchased for $100,000, but appraises for $105,000. Well, now you still only owe $80,000 because that's what you needed to close the mortgage that you needed to close the deal and buy it, but now you have equity of $25,000. So you've got a little more value than what you actually paid for. And this is a good thing. So the way you build equity is one of two ways. You either pay down the debt on the asset, or the asset appreciates or is worth more than it was before. You don't see a lot of equity in cars because cars are not an appreciating asset. They're a depreciating asset. They're worth less tomorrow than they were today, whereas real estate tends to go up in value or appreciate over time. What this means for people who are interested in doing additional borrowing for various purposes, whether it be home improvement or vacation or education or the like, is that you can use the equity in your home. So let's take our example again. Let's say you have a house that you originally purchased for $100,000. It's now worth $140,000. Your mortgage for $80,000 has now been paid down to $70,000. So now you have an asset worth $140,000, you have a debt of $70,000, you have equity of $70,000, and you can borrow against that equity on either a line of credit or a fixed home equity loan and use the dollars up to that $70,000 for whatever purposes you need. And the rates depend on your ultimate loan to value. We look at the sum of the first mortgage and then of the equity loan and compare that to the value. And if it's less than 80%, you get our best deal. If it's between 80 and 90, it's a slightly worse deal. And if it's between 90 and 100, it's slightly worse yet again in terms of your rate. But you can use that equity for that purpose. If you don't pay on the equity loan, then the lender has the option of foreclosing on your mortgage like they would if you weren't paying on your first mortgage. So it's very important if you take out this type of loan that you make your payments on time and keep that current, because the consequences could be pretty significant. So that's how equity and equity loans work. Thank you for watching.